In today's economic landscape, we are witnessing a significant shift towards a high interest rate environment. This means that borrowing costs for individuals, businesses, and even governments have risen notably. Central banks, the guardians of monetary policy, often raise interest rates as a lever to control inflation. When prices of goods and services increase too quickly, it erodes purchasing power and can destabilize an economy. Central banks employ interest rate hikes as a measure to curb spending and cool down an overheating economy. Think of it like adjusting the temperature dial on a thermostat. When inflation runs hot, central banks raise rates to moderate economic activity. Conversely, when economic growth slows down, they may lower rates to stimulate borrowing and spending. This delicate balancing act aims to maintain price stability and foster sustainable economic growth. However, the current surge in interest rates presents unique challenges for investors. Strategies that thrived in a low interest rate environment may no longer be as effective, demanding a reassessment of portfolios and a recalibration of investment approaches. Navigating this new landscape requires a clear understanding of how high interest rates impact different asset classes and a willingness to adapt investment strategies accordingly. The decisions made today will shape the financial outcomes of individuals and institutions for years to come. The era of low interest rates led many investors to embrace a certain comfort zone. The shift towards higher rates necessitates exploring new strategies. Investment strategies must be tailored to individual goals and risk tolerance. Flexibility and adaptability are crucial in this evolving financial landscape. Understanding asset classes like bonds and stocks is essential. Knowledge is power. It's the first step to securing your financial future. Bonds operate on a fundamental principle: the inverse relationship between interest rates and bond prices. As interest rates rise, bond prices fall. When rates decline, bond prices increase. Think of bonds like seesaws with interest rates on one end and bond prices on the other. A bond with a fixed 3% coupon rate becomes attractive in a low-rate environment. If rates rise to 4%, the bond's price declines as new bonds offer higher yields. Understanding this principle is crucial for navigating high interest rate environments. In a high interest rate environment, bond investors need to adapt their strategies. One strategy involves short-duration bonds, which are less susceptible to interest rate fluctuations. Think of short-duration bonds as a quick stroll in a park, easily cut short if needed. Another option is Treasury inflation-protected securities, TIPS, which adjust with inflation. TIPS act like a financial umbrella, expanding as inflation rises. Incorporating short-duration bonds and TIPS can mitigate rising interest rate impacts. High-quality corporate bonds balancing risk and reward. Government bonds offer stability, but high-quality corporate bonds provide higher yields in a high-interest rate environment. Issued by financially sound companies, these bonds balance risk and return. Think of it as a spectrum of risk and reward. Government bonds are low-risk, low-return. Junk bonds are high-risk, high-return. High-quality corporate bonds sit in the middle, balancing risk and return. The pitfalls of long-term bonds, a cautious approach. Long-term bonds with maturities over 10 years are highly sensitive to interest rate changes. Rising rates can erode their value significantly. Investors should assess risk tolerance and interest rate outlook. Diversification and active monitoring are crucial. The valuation game: high rates and the shifting sands of stock prices. High interest rates reshape stock valuations, especially for growth stocks in tech and innovative sectors. Imagine the stock market as a grand auction house, where investors bid on future earnings potential. Higher rates increase the discount rate, pulling down valuations, especially for growth companies. Investors must focus on quality, sustainable growth, and reasonable valuations. Sector spotlight: navigating the uneven impact on stocks. The stock market's response to high interest rates varies by sector. Financial sectors often benefit, while real estate and consumer discretionary sectors face challenges. Diversification can help mitigate risks in a changing interest rate landscape. Dividends in the limelight. Seeking income in a high-rate world. In a high-interest rate environment, where fixed income investments like bonds become more appealing due to their higher yields, dividend-paying stocks can offer a compelling alternative for income-seeking investors. Companies that consistently distribute a portion of their profits to shareholders in the form of dividends can provide a steady stream of income, potentially offsetting some of the volatility often associated with stock market investments. Think of dividend-paying stocks as fruit-bearing trees in an orchard. Just as these trees provide a regular harvest of fruits, dividend-paying companies offer a consistent flow of income to their shareholders. In a high-interest rate environment where the opportunity cost of holding cash diminishes, the allure of dividend income becomes even more pronounced. However, not all dividend-paying stocks are created equal. Investors need to be discerning, focusing on companies with a proven track record of dividend payments, strong cash flows to support those payments, and a sustainable business model capable of generating profits even in challenging economic conditions. Comparing dividend yields, calculated by dividing the annual dividend per share by the stock price, with prevailing bond yields can provide insights into the relative attractiveness of dividend-paying stocks. When dividend yields are competitive with or exceed bond yields, it can signal a potentially attractive income opportunity for investors. A balancing act weighing growth versus value in a changing landscape. The tug-of-war between growth and value stocks is a perennial theme, especially in a high-interest rate environment. Growth stocks are sensitive to rising rates due to their higher valuations based on future earnings. Value stocks represent established businesses with stable earnings and lower valuations. Think of it as a balancing act on a seesaw. Low rates elevate growth stocks, while rising rates favor value stocks. Value stocks, often in energy, utilities, and consumer staples, show resilience in high-rate environments. These companies generate steady cash flows, pay dividends, and have less debt. Investment decisions should be based on thorough analysis of individual companies. A balanced approach, incorporating both growth and value elements, can help mitigate risks and enhance returns. Diversification, the cornerstone of resilience. Diversification is a steadfast principle in investing, providing stability amidst market uncertainty. It acts as a safety net, spreading risk across various asset classes. This mitigates risk without sacrificing returns. Different assets often move independently, offsetting losses and smoothing volatility. Cash is king, the allure of liquidity in uncertain times. In uncertain times, cash emerges as a strategic asset, enhancing portfolio resilience and unlocking opportunities. Think of cash as a chameleon, adapting to its environment. In a high-interest rate world, cash regains its allure, offering flexibility and liquidity. It provides a cushion against losses and the ability to capitalize on market downturns. Alternatives on the horizon, exploring unconventional avenues. Traditional assets like stocks and bonds are common, but high interest rates push investors to explore alternatives for diversification and inflation hedging. Commodities like oil and gold and real estate offer unique benefits and risks. Think of them as spices, adding depth and complexity to your portfolio. With careful consideration, these alternatives can enhance portfolio resilience. Navigating the labyrinth. A prudent approach to investment decisions. Navigating the intricate world of investing can feel like traversing a labyrinth. However, with knowledge, a clear strategy, and prudence, investors can confidently navigate this complex terrain. Conduct thorough research or seek guidance from a qualified financial advisor. Diversification is paramount, spreading investments to mitigate risk. Regularly review and rebalance your portfolio. Investing is a marathon, not a sprint. Stay informed, seek expert advice, and make well-considered decisions to navigate the labyrinth of investing with confidence. High interest rates in a connected world. In today's interconnected global economy, one country's actions can send ripples worldwide. Raising interest rates can create a domino effect, influencing global investment and currency values. Imagine the global economy as an ocean, with each country as a ship. A major economy adjusting its sails creates waves affecting other ships. Similarly, raising interest rates alters global capital flows. Higher rates attract foreign investment, strengthening the currency. This makes exports more expensive, impacting trade balance. Lower rates may cause capital outflows. This influences currency exchange rates and import costs. Understanding these interconnections is crucial for investors. The art of anticipation, watching for signs of a policy pivot. Investors, like skilled chess players, anticipate central bank moves. They watch for signs of a policy pivot, especially when banks signal a shift from raising rates to easing. Central bank policy swings like a pendulum between tightening and easing to maintain economic balance. Investors monitor economic data and central bank communications for clues about future interest rates. Signals of a pause or rate cuts can lead to rallies in bond and stock prices. In the ever-evolving landscape of investing, where market dynamics shift and interest rates fluctuate, staying ahead of the curve requires a proactive and informed approach to decision-making. It's not enough to simply react to market movements. Investors need to anticipate potential changes and position their portfolios accordingly. Think of investing as navigating a ship through unpredictable waters. A skilled captain doesn't simply wait for storms to hit, they monitor weather patterns, chart a course, and adjust their sails to harness the wind and avoid potential hazards. Similarly, informed investors stay abreast of economic trends, monitor interest rate movements, and assess the potential impact on different asset classes. This proactive approach involves staying informed about global macroeconomic conditions, central bank policies, and geopolitical events that can impact financial markets. It also entails conducting thorough research, seeking guidance from qualified financial advisors, and diversifying investments to mitigate risk. Remember, knowledge is power, and in the world of investing, staying informed is paramount. By understanding the forces driving interest rate movements, anticipating potential policy shifts, and making well-considered decisions, investors can navigate the complexities of a high interest rate environment and potentially enhance their chances of achieving their long-term financial objectives. Embarking on a journey through investing requires understanding your risk appetite and time horizon. Like a mariner, assess your tolerance for market fluctuations. Are you comfortable with high-risk ventures or prefer conservative investments? Your time horizon also shapes your strategy. Long-term goals allow for growth-oriented approaches. Short-term needs may require conservative strategies. Regularly reassess to stay aligned with your goals. Once you understand your risk appetite and time horizon, chart your course through the vast ocean of investment opportunities. Asset allocation is the cornerstone of a well-crafted investment strategy. Think of it as the rudder of your investment ship. Divide your capital among different asset classes like stocks, bonds, real estate, and commodities in proportions that align with your risk tolerance and goals. Create a diversified portfolio to weather market storms. In high-interest rate environments, revisiting your strategy is crucial. Different asset classes respond differently to rising rates. This can throw your portfolio off balance. For instance, long-term bonds are sensitive to rate increases. Consider reallocating to shorter-term bonds or other less impacted asset classes. Regularly review and rebalance your portfolio. This helps manage risk and enhance returns. Keep your financial journey on course. Navigating the intricate world of investing, especially amidst the ever-changing tides of a high-interest rate environment, can be akin to sailing through uncharted waters. While a seasoned mariner might relish the challenge, for many, seeking the guidance of an experienced navigator, a financial advisor, can provide invaluable support and peace of mind. Financial advisors are like seasoned navigators, equipped with the knowledge, experience, and tools to help you navigate the complexities of the financial markets. They can provide personalized advice tailored to your individual circumstances, financial goals, and risk tolerance. A qualified financial advisor can help you assess your risk tolerance and time horizon, develop a personalized investment strategy, choose appropriate investments, monitor your portfolio and make adjustments, and provide ongoing education and support. Seeking expert guidance from a financial advisor doesn't mean relinquishing control of your finances. It's about partnering with a trusted professional who can provide valuable insights, support your decision-making process, and help you navigate the complexities of the financial world with confidence. Just as a skilled navigator can guide a ship safely through treacherous waters, a qualified financial advisor can help you chart a course towards your financial goals, even amidst the challenges of a high-interest rate environment. As we've journeyed through the intricacies of investing in a high-interest rate environment, one overarching theme emerges as a guiding principle: adaptability. Just as a seasoned sailor adjusts their sails to harness the power of shifting winds, savvy investors must remain flexible, willing to adapt their strategies to navigate the ever-changing currents of the financial markets. We've explored the impact of rising rates on various asset classes, from the inverse dance between interest rates and bond prices to the shifting valuations of growth and value stocks. We've delved into the importance of diversification, the allure of cash as a strategic asset, and the potential benefits and risks of exploring alternative investments. Throughout this exploration, the need for a well-defined investment strategy, tailored to your individual risk tolerance, time horizon, and financial goals, has remained paramount. A deep understanding of your investment personality, coupled with thorough research or guidance from a qualified financial advisor, empowers you to make informed decisions aligned with your long-term aspirations. Investing at its core is not merely about chasing returns, it's about aligning your financial resources with your life goals, creating a secure foundation for your future and that of your loved ones. In a high-interest rate environment, where market volatility can test even the most seasoned investors, it's essential to maintain a long-term perspective, keeping your eyes fixed on the horizon, beyond the immediate swells of the market. Remember that market fluctuations are a natural part of the investment cycle. Much like the ebb and flow of tides, while it's natural to feel a sense of unease during periods of market turbulence, it's crucial to avoid making impulsive decisions driven by fear or short-term market noise. Instead, focus on the fundamentals: a well-diversified portfolio, a sound investment strategy, and a trusted financial advisor by your side. Stay informed about economic trends and interest rate movements, but don't let short-term market swings derail your long-term financial plan. Just as a skilled captain navigates their ship through calm waters and stormy seas, you, too, can navigate the complexities of the financial markets with confidence, adaptability, and a steadfast commitment to your financial goals. By staying true to your investment principles, weathering the inevitable storms, and maintaining a long-term perspective, you can position yourself to reach your financial destination, even amidst the challenges of a high-interest rate environment. Navigate wealth with Svoboda Finance.